Disclaimer.
Stop scrolling. This is not a drill, and it's definitely not clickbait. What I am holding in my hand right now is the official transcript from the February 4th Washington Ministerial, and it contains a set of new rules that just changed the silver market forever. While the retail crowd was panic selling the $70 dip last week, Vice President J.D. Vance was quietly standing in front of 50 world leaders, confirming the death of the free market for critical minerals. He officially proposed enforceable price floors to stop China from ever crashing our supply chains again. But here's the part the mainstream media missed. On Monday, the White House officially launched Project Vault, a $12 billion strategic stockpile backed by a $10 billion Exim bank loan. This is the government effectively becoming the buyer of last resort for the exact metals needed for AI, defense, and the energy grid. If you think silver, the most conductive metal on Earth, isn't on that list, you aren't paying attention to the math. We are moving into a preferential trade bloc where the old paper shorts are about to get incinerated by a government-mandated floor. In the next few minutes, I'm going to show you why the Monday reset is the moment the exit door for the banking system officially slams shut. You need to know these new rules before the market opens tomorrow, because once the Vance floor is in place, $1,000 silver isn't just a dream, it becomes a mathematical necessity. Lock in. Let's look at the documents. Now here's what most people missed in that announcement. This wasn't some abstract policy discussion or a suggestion for future legislation. Vance revealed that our government is now using tariffs as an automatic enforcement mechanism. Think about what that actually means. Every time silver tries to fall below a certain price, tariffs kick in automatically on any country trying to sell us cheap silver. The government essentially becomes the buyer of last resort, but without spending a single dollar from the Treasury. You've probably noticed how much attention gold gets in financial media. Everyone talks about gold reserves, gold prices, central banks buying gold. But silver? Silver trades in the shadows. That's exactly how certain players wanted it. For decades, a small group of institutions has maintained massive short positions in silver, betting against the price while the industrial world quietly consumed more silver than mines could produce. The math never added up, but as long as paper contracts outnumbered physical metal by enormous margins, the game continued. Here's where it gets interesting. That ratio I just mentioned, paper to physical, it currently stands at 356 to 1. Let me put that in perspective for you. For every actual ounce of physical silver that exists in tracked inventories, there are 356 paper claims on that same ounce. Imagine if 356 people showed up at a bank with deposit slips for the same safety deposit box. Now imagine the government just announced its standing guard at that bank, making sure the box never gets emptied below a certain level. The short sellers built their entire strategy on one assumption. They could always push prices lower when they needed an exit. They'd sell massive quantities of paper silver, watch the price drop, buy back those contracts at lower prices, and pocket the difference. Rinse and repeat. This worked because there was always a floor of sorts, just not an official one. Mining costs created a natural bottom. When silver got cheap enough, mines would close, supply would tighten, and prices would recover slightly. The shorts would cover their positions in that chaos and start the cycle again. But Vance just changed the game completely. Instead of a natural floor created by mining economics, we now have an artificial floor backed by the United States government and enforced through our most powerful economic weapon, tariffs. The shorts can't push prices down to cover their positions anymore. The profit mechanism just vanished. And here's the kicker. The upside remains completely unlimited. We've created asymmetric risk that's never existed before in commodity markets. Think about this from your perspective as someone who might own silver coins, or maybe has some silver in a retirement account. You've watched the price bounce around for years, never quite breaking out like gold does. Maybe you wondered why silver seems stuck despite all the industrial demand you keep hearing about. Electric vehicles need it. Solar panels consume massive quantities. Every smartphone in your pocket contains it. 5G infrastructure can't function without it. Yet the price kept getting hammered down every time it tried to rally. Now connect those dots. If industrial demand keeps growing while short sellers keep suppressing prices, something has to give. Physical silver has to come from somewhere. This is where the inventory numbers should grab your attention. The COMEX, which is America's primary silver exchange in New York, has seen its inventories drop by 70%. The London Bullion Market Association, which handles global silver trading, is down 40%. Shanghai, which processes most of Asia's silver, sits at decade lows. So we've got paper claims at 356 to 1, physical inventories collapsing across all major markets, and now the US government just installed a price floor using tariff enforcement. What happens when short sellers realize they can't drive prices down to cover their positions? They have to buy physical silver at whatever price they can get it. But there's a problem. The physical silver isn't there. Let me walk you through what this looks like in practice. Imagine you're that trader again. You sold contracts promising to deliver 10,000 ounces of silver at $50 per ounce, expecting the price to drop to $40 so you could buy it back cheaper and keep the difference. That's a $100,000 profit if your bet works. But now, the government says silver won't go below $55 because of automatic tariffs. You can't cover your position. You have to either deliver the actual physical silver or pay the current market price to close out your contracts. Pop quiz, where are you going to find 10,000 ounces of physical silver when COMEX inventories are 70% depleted and hundreds of other traders are trying to do the exact same thing? You're going to bid the price up. You have no choice. And when you bid it up, you trigger margin calls on other short sellers who now have to cover their positions too. This is how a cascade begins. But here's what makes this different from previous short squeezes you might have read about. Those happen because of market dynamics, temporary shortages, or coordinated buying. This is happening because the United States government just positioned itself between short sellers and their exit strategy. We're not talking about a Reddit forum pumping a stock or a billionaire trying to corner a market. We're talking about federal policy enforced through our tariff system, backed by a 55-nation trading bloc that Vance specifically mentioned in his announcement. Think about what that means. Our government is now working with nations that control the majority of the world's silver mining capacity. They're not just defending a price floor in New York trading pits, they're coordinating with the actual sources of physical metal. When you control the supply chain and install a price floor, you're not making a bet. You're restructuring the market. The short sellers have spent decades treating silver like a manageable position. They'd coordinate selling pressure, watch prices drop, cover their shorts, and repeat the cycle. The concentrated nature of these positions meant a relatively small group controlled the market dynamics. Financial regulators have published reports showing just how concentrated these short positions are. We're talking about a handful of institutions holding positions that represent significant percentages of annual global production. Those concentrated positions just became a direct confrontation with U.S. government policy. This isn't a battle between bulls and bears anymore. This is a battle between traders who need prices to fall and a government that just said prices won't fall below a certain level. How does that resolve? History gives us a pretty clear answer. The government with the bigger balance sheet and the tariff authority wins. The traders either capitulate or face potentially unlimited losses. Have you noticed how quiet the financial media has been about this? You'd think an announcement this significant would dominate headlines. Vice President makes major commodity policy announcement. Government installs price floors using tariff enforcement. But outside of specialized financial circles, this story barely registered. That's not an accident. When you understand who benefits from silver price suppression and who loses when that suppression ends, the silence makes perfect sense. What should grab our attention right now is the timeline. Vance made this announcement on February 4th. We're watching in real time as markets digest what this means. The short sellers haven't fully repositioned yet. The physical supply crunch hasn't reached its peak. The 55-nation trading bloc hasn't formalized all its agreements. We're in what intelligence analysts call the fog of war period, where the outcome is clear, but the exact path to get there remains uncertain. This is the moment where information advantage matters most. Understanding what just happened, why it matters, and what comes next gives you a window that won't stay open forever. The question isn't whether silver prices will rise. The question is how high they'll go before the market finds a new equilibrium, and whether you positioned yourself before that discovery happens or after. The mechanism is now in place. The government threw down the gauntlet. The short sellers are trapped. The physical inventories can't meet forced buying demand. Everything that happens next is just math playing out in real time. And that math, it's about to get very interesting for anyone who understands what we're looking at. Let me show you something that should make your jaw drop. 2 days before Vance stood at that podium on February 4th, the White House quietly filed documents for Project Vault on February 2nd. This wasn't a coincidence. This was a coordinated strike against the paper-silver market that had been planned for months. Project Vault is a $12 billion strategic stockpile program. But here's what makes it different from every other government stockpile in history. The Export-Import Bank is providing $10 billion in loan guarantees. Think about what that means. Our government is using taxpayer-backed financing to guarantee that American companies can secure critical minerals at predictable prices. They're not just buying metal. They're locking in supply agreements that remove physical silver from the open market permanently. Now, here's where this gets nuclear. The participant list for Project Vault leaked through industry sources within 72 hours of the announcement. Google is in, Boeing is in, General Motors is in. These aren't speculators hoping silver goes up. These are manufacturing giants who burn through millions of ounces every single year for data centers, aerospace components, and electric vehicle production. When companies of this scale enter a government stockpile program, they're sending a signal to the market. We expect sustained high prices, and we're willing to pay premiums now to guarantee access later. According to documents filed with the Securities and Exchange Commission, the program was oversubscribed within the first week. Industry analysts expected maybe 30 to 40% participation from targeted sectors. They got applications representing over $15 billion in demand against the $12 billion allocation. What does oversubscription tell you? Panic. These companies ran the numbers on what happens when the Vance floor activates and China tightens export controls simultaneously. They saw the same math we're looking at right now, and they scrambled to lock in guaranteed supply before the door closed. Let me put this in perspective for you. Google's data centers currently consume approximately 2 million ounces of silver annually just in server components and cooling systems. Boeing uses roughly 1.5 million ounces per year across its commercial and defense production lines. General Motors committed to producing 1 million electric vehicles annually by 2025, with each vehicle requiring 0.5 to 1 ounce of silver in electrical components. Do the math on that. These three companies alone represent close to 4 million ounces of annual demand, and they just locked themselves into multi-year supply agreements through a government program that guarantees them access at set prices. But here's the question you should be asking. If silver is so abundant and the price has been suppressed for years, why would these companies panic to secure supply? Why pay premiums to join a government stockpile program when they could just buy on the open market? Because they know something the retail market hasn't figured out yet. The physical silver isn't there. Now let's talk about China, because this is where the perfect storm really forms. On January 1st, 2026, China implemented a new export licensing system for refined silver. Not gold, not copper, silver. The Chinese Ministry of Commerce announced that any company wanting to export refined silver must now obtain specific licenses, demonstrate legitimate end-use documentation, and maintain minimum annual production levels of 80 tons to qualify. Here's what that means in practice. China processes somewhere between 60 and 70% of the world's refined silver supply. Even silver, mined in Mexico, Peru, and Australia, often gets shipped to Chinese refineries because they have the capacity and expertise. By requiring export licenses with an 80-ton annual production threshold, China just created an intentional choke point. Small and medium refiners can't meet that threshold. They're frozen out. Large refiners now face paperwork delays, government oversight, and the constant threat of license revocation if they displease Beijing. According to Chinese customs data, October 2025 saw record silver exports of 660 tons. That was front-running. Refiners knew the licensing system was coming in January. They pushed out every ounce they could before the door slammed shut. November exports dropped to 420 tons. December fell to 280 tons. January 2026, after the licensing system activated, 115 tons. The flow didn't slow, it collapsed. Think about the timing here. China announces export controls effective January 1st. Vance announces the Vance floor on February 4th. Project Vault launches February 2nd. This isn't coincidence. This is coordinated economic warfare playing out in commodity markets. And silver is ground zero because it's the one metal where industrial demand absolutely cannot be substituted. You can replace gold with other investment vehicles. You can substitute copper with aluminum in some applications. But silver? Silver is the most conductive metal on Earth. 0.6, 3 million Siemens per meter at room temperature. Nothing else comes close. Copper is 58 million Siemens per meter. Aluminum is 37 million. When you're building 5G infrastructure that requires minimal signal loss, or solar panels that need maximum electron flow, or electric vehicle charging systems that demand rapid energy transfer, you need silver. Period. There is no substitute at the performance levels modern technology requires. Let me show you another piece of this puzzle that confirms everything we're talking about. On November 6th, 2024, the United States Geological Survey officially designated silver as a critical mineral. This wasn't some bureaucratic formality. This designation unlocks Section 232 of the Trade Expansion Act. That's the same authority Trump used for steel and aluminum tariffs. It's the same authority that allows the president to impose tariffs for national security reasons without congressional approval. Now connect those dots. Silver becomes a critical mineral on November 6th. Trump signs an executive order on January 14th, 2026, reaffirming Section 232 authority for critical minerals. 3 weeks later, Vance announces the price floor mechanism using tariff enforcement. The legal framework was built step by step, and industry insiders who were paying attention saw this coming months in advance. According to the Congressional Research Service, Section 232 authority has been invoked 87 times since 1962, but only 3 times for minerals classified as critical to national security. Those 3 instances all resulted in permanent market restructuring. Steel tariffs from 2018 remain in place today. Aluminum tariffs created a domestic production renaissance. Now, silver is getting the same treatment, except this time, we're not just imposing tariffs. We're coordinating with a 55-nation trading bloc that controls the majority of global mining production. Have you looked at the COMEX warehouse data recently? As of February 1st, 2026, registered silver, that's metal available for delivery against futures contracts, sits at 42 million ounces. That sounds like a lot until you realize it represents exactly 3.4 days of global industrial demand. 3.4 days. The London Bullion Market Association isn't much better. Their vaulted silver dropped from 900 million ounces in early 2023 to 540 million ounces by January 2026. That's a 40% decline in just over 2 years. Shanghai stocks are even more telling. The Shanghai Futures Exchange held 87 million ounces in January 2024. By January 2026, that number dropped to 41 million ounces. We're at decade lows across all 3 major global silver trading hubs simultaneously. This isn't a regional shortage. This is a systemic inventory depletion happening while industrial demand accelerates. Let me give you some context on that demand acceleration. The Solar Energy Industries Association reports that utility-scale solar installations in the United States are projected to consume 130 million ounces of silver in 2026, up from 95 million ounces in 2024. That's a 37% increase in 2 years. Electric vehicle production globally is targeting 20 million units in 2026, according to the International Energy Agency. At 0.5 ounces per vehicle, that's 10 million ounces just for EVs. 5G infrastructure build-out requires approximately 100 million ounces annually for base stations, small cells, and backhaul systems. Now add defense consumption. The Department of Defense doesn't publish exact figures, but industry analysts estimate military applications consume between 50 and 80 million ounces annually. Missile guidance systems, radar arrays, electronic warfare equipment, communications infrastructure, all of it requires silver. When you're building hypersonic missiles that need to withstand extreme temperatures while maintaining electrical conductivity, you use silver. There's no alternative that meets the performance specifications. So we've got solar demanding 130 million ounces. Electric vehicles need 10 million. 5G requires 100 million. Defense consumes 50 to 80 million. That's 290 to 320 million ounces annually just from these 4 sectors, and we haven't even counted traditional electronics, medical devices, water purification systems, or financial investment demand. Global mine production in 2025 was 830 million ounces, according to the Silver Institute. You're looking at industrial demand alone consuming 35 to 38% of annual mine supply, and that percentage is growing every single year. But here's what should terrify the short sellers. Project Vault participants are locking up multi-year supply agreements. China's export licensing system removed 60 to 70% of refined supply from free market access. The 55-nation trading bloc Vance mentioned represents countries that collectively produce 600 million ounces annually. That's 72% of global production now operating inside a preferential trade agreement that prioritizes member nations. What's left for the paper market? Maybe 230 million ounces of annual production competing for spot market sales after all the long-term contracts, government stockpiles, and trading bloc allocations are satisfied. Now remember that 356 to 1 paper to physical ratio. When those paper contracts try to take delivery against 230 million ounces of available supply, while COMEX registered inventory sits at 42 million ounces, you're not looking at a short squeeze. You're looking at a market dislocation that could take years to resolve. The Bank for International Settlements published a working paper in December 2025 analyzing commodity market concentration. They specifically highlighted silver as having the most concentrated short position of any major commodity. 4 institutions hold 63% of the net short position. 4. When Vance installed that price floor, he didn't create a problem for the entire financial system. He created a problem for 4 specific institutions that now face the choice between covering their positions at potentially unlimited losses or defaulting on delivery obligations. What happens when a major financial institution defaults on commodity delivery? We don't have to guess. We saw it with nickel in March 2022, when the London Metal Exchange halted trading and canceled trades after a Chinese metals giant faced a $12 billion margin call. Silver is a bigger market with more participants, more industrial users, and now government intervention on a scale we've never witnessed. If you think regulators will step in to save the shorts this time, consider that the government itself is now on the other side of the trade. The Vance floor makes it explicit. We want higher prices, we want secure supply, and we're willing to use national security authority to achieve both goals. This is the proof the skeptics demanded. Project Vault with $12 billion in capital and oversubscribed participation proves industrial panic is real. China's export licensing system eliminating 60 to 70% of refined supply proves the physical shortage is accelerating. Silver's critical mineral designation with Section 232 authority proves the legal framework is operational. Vance's February 4th announcement proves the execution phase just began. The evidence isn't circumstantial anymore. It's documented, filed, and actively being implemented, while most investors are still trying to figure out if this is actually happening. Now, let me show you the math that makes $1,000 silver not just possible, but inevitable. We need to start with a number that most analysts don't want you to see: 820 million ounces. That's the cumulative deficit across 5 consecutive years from 2020 to 2024, according to the Silver Institute's most recent World Silver Survey. Let me break that down so you understand the scale. A deficit means industrial and investment demand exceeded mine production plus recycling. In 2020, the deficit was 51 million ounces. 2021 saw a deficit of 84 million ounces. 2022 hit 237 million ounces. 2023 recorded 142 million ounces. 2024 preliminary data shows 306 million ounces. Add those up, and you get 820 million ounces of demand that wasn't met by current production. Where did that silver come from? Above-ground stockpiles, ETF liquidations, government reserves being quietly drawn down, recycling that pulled silver out of old electronics and industrial waste. But here's the critical question. How much longer can that continue? We just established that COMEX, LBMA, and Shanghai inventories are at multi-year lows. ETF holdings dropped from 1,200,000,000 ounces in February 2021 to 875 million ounces by January 2026, according to data compiled by the World Gold Council. That's 325 million ounces drained from investment vehicles in less than 5 years. 820 million ounces of deficit equals roughly 10 months of current global mine production. Think about what that means. Over 5 years, the world consumed 10 additional months' worth of silver beyond what was mined during that period. And this calculation doesn't include something most people don't even know exists: the military consumption blackout. In 1996, the United States government stopped reporting Defense Department silver consumption. They classified it. For 30 years, from 1996 through 2026, we have no official data on how much silver our military has consumed. Industry experts estimate it's somewhere between 50 and 80 million ounces annually, but those are educated guesses based on weapons production rates, electronics procurement contracts, and aerospace manufacturing data. Let's use the conservative estimate of 50 million ounces per year. Over 30 years, that's 1,500,000,000 ounces of military consumption that isn't included in the Silver Institute's deficit calculations. If we use the higher estimate of 80 million ounces annually, we're looking at 2,400,000,000 ounces. The real deficit over the past 5 years might not be 820 million ounces. It could be closer to 1,600,000,000 ounces when you factor in classified military demand. Now let's talk about price discovery, because this is where the mathematical necessity becomes undeniable. Gold is currently trading around $6,500 per ounce as of early February 2026. Ed Yardeni, one of Wall Street's most respected economists, published a report in January projecting gold could reach $10,000 per ounce by late 2026, based on continued Federal Reserve policy uncertainty, geopolitical tensions, and central bank buying. The gold-to-silver ratio currently sits at approximately 65 to 1. That means 1 ounce of gold buys 65 ounces of silver. Historically, that ratio has averaged around 50 to 1 over the past century. But if you go back further, to periods when silver was actually used as monetary metal rather than just industrial commodity, the ratio was 15 to 1. That was the ratio embedded in U.S. coinage before 1965, when silver was removed from circulating currency. Let's run the math using these different ratios. If gold reaches $10,000, as Yardeni projects, and the gold-to-silver ratio remains at its current 65 to 1, silver should trade around $154 per ounce. That's more than double the current price of $75, and we haven't even factored in the Vance floor or the supply squeeze yet. That's just normal ratio reversion. But here's where it gets interesting. The current 65 to 1 ratio exists in a world where silver is treated primarily as an industrial commodity, not as a monetary metal. What happens when governments start stockpiling silver through programs like Project Vault? What happens when 55 nations form a preferential trade bloc that restricts silver exports to non-members? Silver starts behaving less like copper and more like gold. It regains its monetary premium. If the gold-to-silver ratio reverts to its historical 50 to 1 average, and gold hits $10,000, silver trades at $200 per ounce. If we see a full reversion to the 15 to 1 ratio that existed when silver had true monetary status and gold reaches $10,000, silver hits $666 per ounce. These aren't wild speculations. These are mathematical calculations based on historical precedent and respected analyst projections for gold. Now add the supply constraints we've discussed. When China cut refined silver exports by 82% in the first month of their licensing system, they didn't just reduce supply, they fundamentally changed market structure. According to the China Nonferrous Metals Industry Association, domestic Chinese demand for silver in industrial applications grew by 23% in 2025. China is consuming more of its own refined silver rather than exporting it. That trend isn't reversing, it's accelerating. Mexico, which is the world's largest silver mining country producing approximately 190 million ounces annually, is part of the trade bloc negotiations that Vance mentioned. The current bilateral plan with Mexico expires in April 2026, according to the Office of the United States Trade Representative. What happens when that bilateral agreement gets folded into the larger preferential trade bloc? Mexican silver production gets allocated to bloc members first. Non-members, including China, have to compete for whatever's left at whatever price the bloc sets. Peru produces roughly 120 million ounces annually. Australia produces around 50 million ounces. Chile contributes 45 million ounces. Poland produces 40 million ounces. These are all countries either already in the trade bloc or actively negotiating to join. When you add up the production from confirmed and likely bloc members, you're looking at approximately 600 million ounces out of 830 million ounces of global production. That's 72% of world supply operating inside a closed system that prioritizes member nations. Let me give you a scenario that shows how quickly this could spiral. It's June 2026. The bilateral Mexico plan has been folded into the formal preferential trade bloc. Project Vault procurement has been running for 4 months, removing approximately 40 million ounces from the market through long-term contracts. China's export restrictions have forced European and Asian manufacturers to compete for the remaining 230 million ounces of freely traded silver. The Vance floor is enforced at, let's say, $85 per ounce through automatic tariffs on any imports below that price. A major investment fund decides silver looks attractive and attempts to take delivery of 20 million ounces against COMEX futures contracts. COMEX registered inventory sits at 38 million ounces after 4 months of steady drawdown. The fund's delivery request represents 53% of available registered inventory. COMEX either delivers the metal, which crashes registered inventory to 18 million ounces and triggers panic among other contract holders, or COMEX settles in cash at current market prices, which signals to the world that paper contracts are no longer backed by physical metal. Either outcome destroys confidence in the paper market. If they deliver, everyone rushes to take delivery before inventory hits zero. If they cash settle, everyone realizes their paper claims are worthless and scrambles to buy physical metal elsewhere. Both scenarios result in massive upward pressure on spot prices as buyers compete for scarce physical supply while the Vance floor prevents any meaningful price decline. This isn't theoretical. We watched a version of this play out in nickel in March 2022. We saw it in palladium in 2021. We're watching it develop in copper right now as electrification demand overwhelms supply. Silver has all the same dynamics, except magnified by a decade of deficit spending from above-ground inventories, government intervention through price floors, and geopolitical export restrictions from the world's largest refining nation. The convergence point is Q2 to Q3 2026. That's when multiple catalysts hit simultaneously. The Mexico bilateral plan expires in April and gets folded into the larger bloc, formalizing supply restrictions. Project Vault procurement enters its heaviest phase as participating companies front-load purchases to meet multi-year commitments. The post-crash speculative positioning resets as short sellers who survived the February volatility realize the Vance floor isn't temporary policy, it's permanent market structure. And most importantly, the physical shortage that's been building for 5 years finally becomes undeniable to mainstream investors who've been ignoring silver while chasing other assets. According to CPM Group's latest silver market analysis published in January 2026, they project the deficit for 2026 could reach 350 million ounces. That's 42% of annual mine production. Even with increased recycling and some mine expansion, there's no way to fill that gap from current supply sources. The silver has to come from somewhere, which means either prices rise high enough to destroy demand, or governments restrict exports to protect domestic supply, or both. Here's what should concern every investor right now. The window for sub-$100 silver is closing rapidly. We're currently at $75. The Vance floor isn't publicly specified yet, but industry analysts believe it's being set somewhere between $85 and $95 based on the tariff structure needed to make enforcement viable. Once that floor is official and actively enforced, you're not buying silver below that level anymore, unless you're getting it from someone desperate to liquidate for personal reasons. Think about the asymmetric opportunity this creates. If silver goes to $150, you're looking at 100% returns from current levels. If it goes to $200, based on the 50-to-1 gold ratio reversion, that's 166% returns. If we see monetary premium return in a 15-to-1 ratio with gold at $10,000, that's $666 per ounce, or 787% returns. Your downside is protected by a government-enforced price floor, while your upside is driven by mathematical necessity, supply constraints, and historical ratio reversion. The banking system exits are closing. The four institutions, holding 63% of the concentrated short position, are trapped between a government-mandated floor and a supply squeeze they can't escape. When Vance stood in front of those 50 world leaders on February 4th, he wasn't making a policy suggestion. He was announcing the end of the free market for strategic minerals, and silver is the most strategic mineral in the modern economy. Everything from AI data centers to hypersonic missiles to solar panels requires it, and there isn't enough of it to meet demand at current prices. $1,000 silver isn't a dream scenario anymore. It's a mathematical inevitability once the full weight of government intervention, supply restrictions, and historical ratio reversion plays out over the next 12 to 24 months. The Monday reset on February 2nd, when Project Vault launched, was the starting gun. The Vance floor announcement on February 4th was the confirmation. Everything happening now is just the market slowly realizing what the informed players figured out months ago. You're watching the greatest wealth transfer in commodity market history unfold in real time. The question isn't whether silver reaches 4 digits. The question is whether you positioned yourself before the exit door slammed shut, or whether you waited until mainstream media finally figured out what was happening and prices had already moved beyond reach for average investors. The documents are public. The math is undeniable. The timeline is accelerating. What you do with this information in the next 30 to 60 days could define your financial position for the next decade.